Mike Douglas is Michigan's retirement coach.
Do you need a tax planner for retirement? This is the question that we are posing today. Certified financial planner, Michigan's retirement coach, Mike Douglas, is here to explain. Well, you have a list that you have cultivated that we're going to work our way through. 5 reasons why you need a tax advisor. Is it for retirement? Is it in retirement? Is it both? I'm guessing it's both.
Both.
Yeah. All right.
Yeah,
well,
absolutely.
Tell us what it is, sir.
So taxes are just part of life. Like
Sure.
we have to deal with it. We have to.
Is it
live
Benjamin
in this
Franklin?
world where
Nothing is certain in life but death and taxes? Was it Benjamin Franklin that said that?
Yeah.
Yeah.
Yep. And that's one of the most important things to know is that there is this system of rules we have to play within. Mm-hmm. But the better we know the rules, the better we can play within the rules, and the more likely we can win within the rules.
Yeah.
Right? It's like that's what we have to build a strategy for. And unfortunately, people just say taxes. They put zero effort into tax strategy and planning in retirement or in their working years.
So many of us think we just got to take it, right? It's just that you just got to take it. Just take it.
Yeah. And there's nothing else you can do. But there is stuff you can do.
Okay.
You can be strategic. You can be tax forward thinking rather than tax backward thinking. When we do tax preparation every spring, it's a backwards term. Tax prep means prepare to pay the taxes on what you've already done. There's very little going back and fixing it. There's definitely no proactive planning you can do when looking in the rearview mirror. But moving forward, there are good strategies that you can use to minimize or pay taxes on your timetable rather than the government's.
Okay.
Some things we can't avoid, but some things we can look at the scope of our life, whether it's the next 10, 20, 30, or 50 years, and say, how much am I projected to pay in taxes over that time frame, and how can I shrink that number? That's what tax planning is.
Okay.
It's not tax preparation.
Yeah.
Tax planning says over the next 40 to 50 years or 30 or 20, however many we have left on this earth, how can I shrink that number? That's why you want to consider having a tax advisor in retirement. So here are the 5 reasons you need a tax advisor in retirement.
All right.
Number 1, retirement income is taxed differently. It is flat out different. When we're working, we have wages. We're W-2 or we're 1099 or you own a business and you get K-1s, whatever it is. There is a lifestyle, like a working tax system. And then there's this retirement income tax system. I have Social Security benefits that come to me. Is that taxed or not? Depends on how much you have. It depends on how much other sources of income you have. Pensions, depending on your state, is it taxed or not? And how that affects the rest of your thing. But at the same time, on the federal level, almost always taxed. IRA distributions versus Roth distributions. One is taxed, one isn't, unless it's not old enough. There's a lot of moving pieces there. Without planning, people pay more than necessary just because they don't have a distribution strategy in retirement. Life is built of these 3 phases: accumulation, preservation, and distribution.
Okay.
Accumulation is what you do while you're working. Preservation is what you do when you start retirement.
Yeah.
Distribution is how you get your money out. So rather than just keeping it safe, how do I get it out in the most tax efficient way possible?
Okay.
That is distribution. Retirement income, if I pull from my IRA, now I pay more in taxes on my Social Security. If I invest in municipal bonds, and they're paying out tax-free interest, they can still trigger taxes on my Social Security. So we want to know how things relate to each other and just understand that, number 1, retirement income is taxed differently than regular income.
Okay.
Number 2, timing matters more than rate of return.
What does that mean?
Timing matters.
Okay.
Sequence of returns risk is a thing that affects retirees more than workers. If you are working and the stock market crashes, it's a good thing for you, not on your statements, but in your opportunity. If you keep dumping money into your 401k and the market's crashing and you're buying more shares at a lower price, it's called dollar cost averaging. It's going down. I'm buying more shares. Then when it bottoms out and comes back up, I have more shares and I recover and end up with a lot more money. It's a beautiful opportunity for the worker. It's a real danger for the retiree. If you retired in 1999, right, and you say, oh man, the market's been good for 20 plus years. The market just keeps on making money, double digits every year. I cannot wait to retire and live off this money. And then in 2001, 2, and 3, the stock market crashed for 3 straight years, lost 43% over 3 straight years.
Yeah.
And you retired and you were taking out 4% a year. You have $1 million account. So you're going to live on $40,000 a year using the rule of 4%. The first year, the stock market dropped 20%. You pulled out 40, the market lost you 200, you're down $240,000. Then you go to your next year. Do you still want to take out $40,000? Yeah.
Well, you need it,
Right,
whether you want to or not.
I need, that's what my lifestyle costs.
Yeah.
So now I take out another $40,000. So now my million is down to $720,000, and it had another negative 10% year.
Yep.
So now it's down another 72,000. Then the next year you want to take out another 40,000, but then it lost another 11%, losing 43% over 3 years. So while the market was down 43%, you're down over 55% 3 to 4 years in retirement.
Mm-hmm.
Now that's the worst case scenario, but that's what sequence of returns risk means. When you retire and when you start drawing money out matters. Take the exact opposite scenario. You retired March 2nd, 2009. I'm picking that date very specifically because it's the bottom of the market at the end of the financial crisis, the great financial crisis.
Yeah.
You retired with $1 million there. Moving forward, the market made so much money over the next, going on 17 years. So what happened to you? You had $1 million left after the financial crisis. You retire and take out $40,000. But yet the market finished up over 20% that year. So your million goes to 1.2. You take out your 40, you're at 1.16 million. Then the market goes up again in 2010. And it goes up again. 2015 was a first negative year since 2009. It was negative 0.67%. So year over year, your portfolio grows and you're taking out 4%, which means you get to take out more income every single year. It's a beautiful thing. My portfolio grows. I get 4% of a bigger number. I bring it down. It grows again. So your life experience is based on the fact that the market always makes money when I'm retired. I get a pay raise every single year. The same scenario at the wrong time frame says I get less and less every year, or I hurt myself with my portfolio.
But what does that have to do with taxes, though?
Because when we're going through, timing matters more. When you take out your money, it's taxable as well. Strategically pulling versus Roth and IRA.
Okay.
So in that same scenario, sequence of return, how much you take out.
Yeah.
I'm being taxed as I'm taking money out of an asset. Again, if you need $40,000 a year, that's net after tax.
Mm-hmm.
How much does it cost me to get it? Probably $50,000.
So the idea of
10 grand.
You having a proper withdrawal strategy in times of a down market, so you are taxed less to help offset losses. Okay.
Right. Or in those moments when there's really good gains and you're on the upside, pay some extra taxes to keep money that is after tax now. So if you need it in the future and the market's down, I'm not doing taxes and withdrawals during a down market.
Yeah.
If the market's up, pay some extra taxes, throw it in a Roth or throw it in a trust or non-qualified account. That way, when markets are down and you pull, I'm not pulling out $50,000 to get $40,000 while the market's down $200,000.
Okay.
We don't want to compound losses with income and taxes.
Yeah.
So understanding the consequences there.
Okay.
Number 3, tax loss harvesting and offsetting gains. Understanding that there is this balance that we have to live in the tax world.
Yeah.
If I sell something at a gain and I sell something at a loss and they're the same type of gain or loss, that means I don't pay any taxes if it's even. If I put them both on the scale, 200,000 in gains, 200,000 in losses, they even the scale out and I pay nothing in taxes as long as they're the same. Not same like real estate to real estate or stock to stock, but long-term to long-term or short-term to short-term. As long as the types line up, I can get rid of gains by selling something else at a loss, pay nothing, and then rebalance my portfolio. Knowing the timing of that, when does it make the most sense to tax loss harvest? Some people like to do it at the end of the year because they get there, they kind of see how it's going to settle out. Other times, though, when we look at, we're trying to accomplish specific goals, I don't want a loss to go to waste.
Sure.
So sometimes the problem is if something's at a loss, 15% loss, 20% loss, whatever it is, and you can sell out of a position that you don't like anymore.
Before it comes back?
Before it comes back.
Got it. Okay.
Right?
Yeah.
So for example, I had one client who had just a bunch of losses in bonds.
Yeah.
Because it was after 2022 when stocks and bonds fell simultaneously 20%.
Yeah.
It takes a long time for bonds to recover 20%. It does not take long for good equities to recover 20%.
Right.
So when those bonds were at a 20% loss, we sold them to offset some stock gains. But then we took that bond money, repositioned it as stocks, participated in the rally, got the money back way faster, and then rebalanced again. So sometimes it's not about waiting till the end of the year. It's about just knowing the timing of the market.
Got it.
In addition to the timing of the year. So don't let it go to waste.
Okay.
Reason number 4, you should consider having a tax advisor in retirement, legacy and estate planning.
Mm-hmm.
If you've saved a decent net worth, a sizable net worth, and you say, oh, well, the taxes are my kid's problem, right? I earn this stuff. I'm not paying for estate planning and all that stuff. I think that's foolish. Number 1, your money is because you worked hard and you saved it. And to say it's their problem is to say, I don't care about the work I did to get this money.
Mm-hmm.
Don't think of it as, well, it's still free money to them, so I don't care if they pay taxes on it. Think of it as this. It wasn't free to you. You saved, you earned it. You worked years to get your first $50,000 in your 401k, your first $100,000, your first $500,000. It didn't come quick.
Mm-hmm.
So if it took you 5 years, 7 years, 10 years to get $100,000 in your 401k, and then you say, because it's my kid's problem, I don't care if they screw up the taxes and pay an extra $100,000 in taxes, you're erasing 7 years of savings or 10 years of savings or 5 years of savings. Don't do that. Have a strategy that says, here's how I keep as much of my time and energy that I saved in my family. So don't allow it to become a their problem, my problem thing. Think of it as, if I worked this hard and I did all this work, there's no way I'm going to let these knucklehead kids screwed up and pay too much in taxes,
Mm-hmm.
right? I'm going to make sure that we do it on my terms, on my conditions, with my strategy. So I think that's a better way to think of it. When you do a good estate plan, it gets rid of some optional taxes. Sometimes some of our clients get to the point where estate tax is a real problem. They are going to pass on too much money to their kids, and I don't want them paying a 40% estate tax. Okay. There's strategies for that. You can buy life insurance to cover the estate taxes. You can do certain things to cover the estate taxes. So we just want to make sure that we have a plan that covers whatever our legacy cost or estate planning will be. And number 5, the number 5 reason you may want a tax advisor in retirement, you may need to utilize a virtual family office approach. We have a couple people who have gone through situations, whether they're exiting a company, they're sitting on a sizable IRA. We had one gentleman who came in and he had a $14 million pre-tax IRA.
Wow.
That he took a flyer on a couple of companies about 10 years ago.
Yeah.
And they're all tech companies that have blown up.
Wow.
How do you deal with that? Well, sometimes you just Roth convert it. Sometimes you just pay taxes and deal with it. Or you can utilize a virtual family office, which is using a team of attorneys, CPAs, and tax professionals to find creative ways to eliminate the taxes on it. So if you don't know what a virtual family office is, basically think of it as, rather than going to a million different people's offices trying to connect these dots, what you do is you work through a company that will say, I've got attorneys, CPAs, all these strategies. We can make it work for you. That's one of the things we do at Michigan's Retirement Coach. We use virtual family offices. We use estate planning and legacy planning. We use tax loss harvesting strategies. We make sure our income is taxed appropriately. And we know that the timing of when you do or don't pay taxes matters, and it affects your returns. So know that it's powerful to have tax plans. We have yet to talk about through this whole thing, whether you should buy an annuity or not, whether you should buy Apple stock, whether you should invest in an ETF versus mutual fund. Those are separate things. But at the end of the day, you've invested over your life in mutual funds, rentals, real estate, stocks, whatever you've invested in.
Yeah.
At the end of the day, we still live in the net of what's left after taxes.
Okay.
So having a tax advisor who can help you understand your tax situation and can avoid the optional taxes is a wonderful tool to have in retirement. I think that's worth it. That's what we talk about a ton. That's why we have this channel, is to communicate things that the financial industry doesn't talk to you about, to give you the rest of the story, to quote Paul Harvey, right? About the ugly side of retirement sometimes, which is taxes. Deal with it, have a strategy for it. That way you're not just beholden to taxes.
Right. You don't have to just take it in the face from Uncle Sam.
Nope.
You can do better. Mike Douglas.
Sometimes you can punch back. Sometimes you can punch back.
There it is. That's right. Fight back. It's your money. Fight back. Mike and his team, they're here to do it. MichigansRetirementCoach.com. We also have links posted in the show notes. Should we summarize quickly the 5 reasons why? You want me to do it?
Number one?
Yeah, you do it.
Number 1, retirement income is different than a working income.
It's taxed differently.
Understand how the taxes work. Number 2, timing of distributions and when you pay taxes sometimes matters more than returns. Number 3, use tax loss harvesting to offset gains. Number 4, have a good legacy and estate plan to protect your worth in what you've done. Number 5, Sometimes you need to use a virtual family office to deal with sizable tax issues. Exit of a company, large estates. You use virtual family office, a team of experts to protect what you've built.
It's your money. Fight for it. Keep it. Keep it for yourself, not for Uncle Sam. Somebody's going to spend it. This is the thing. Somebody's going to spend it. Should you spend it? Should your family spend it? Should Uncle Sam spend it? Ask yourself. I think we all know what the conclusion you'll come to is. Mike and his team, they're here to help. MichigansRetirementCoach.com, or click on the links we got posted in the show notes. Let's get to work helping you create a tax strategy for retirement.
Thanks for listening to Michigan's Retirement Coach with Mike Douglas. To learn more, visit MichigansRetirementCoach.com.
Michael Douglas is an investment advisor representative of Stewards Wealth Planning, LLC, a registered investment advisor. Financial professionals are not licensed in all 50 states. To find out if Michael Douglas is licensed in your state, please call 517-323-7526. Stewards Wealth Planning, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Michael B. Douglas, NPN number 9650939.